Yeah, I'm just thinking whether it has been due to RBI is looking to manage inflation through this. Trying to actually inject less liquidity and contain the inflation. But in the process, what we are losing out is our GDP growth. And liquidity to be injected to meet the shortfall which has been created by RBI's own intervention. So that's where I feel the problem lies. See, as far as the development of term structure is concerned, I don't think we have really succeeded. This is my very blunt answer to the question. Now, when we talk about a term structure, if you are thinking that in the yield curve, at every point we need a reasonable amount of secondary market transaction to make it really a tradable kind of an yield curve, I think we clearly don't have that. So I would only say that be alert to the frictional liquidity gaps, be alert to the structural liquidity gaps. Don't allow the structural liquidity gaps to develop at all because this is going to affect the economic growth. Allow the every time fund the structural liquidity gaps through appropriate instruments like OMOs or the FX swaps and the frictional liquidity gaps through the other instruments that we have at our disposal.
Hello, I have with me Mr. G. Mahalingam, formerly the Executive Director of the Reserve Bank of India and also a whole-time member of the Securities and Exchange Board of India. Mr. Mahalingam was the market regulator. He regulated both the currency and the bond market. And he is the best person to speak on a very vexing issue, which is interbank liquidity. And Mr. Mahalingam, welcome to the show.
Thank you very much, Kalyan.
Mr. Mahalingam, thank you so much. Mr. Mahalingam, liquidity has been a big bugbear, so to say, for the financial markets and the economy as a whole. Even though the Reserve Bank of India has cut interest rates in last month, most economists say that it is not really the price of money, but the quantity of money which has become a big problem. And so to that extent, there has hardly been any transmission of the rate cut which was affected last month. And then one is not expecting any sort of transmission till April. So the biggest problem has been that liquidity has seen some sort of whiplashes for the last 4 months. Sometimes it's adequate to excess and sometimes it is in serious deficit. So I wanted to begin by asking you what explains these whiplashes in liquidity in the last several months.
Yeah, let me just outline the factors which bring about these whiplashes actually. The most important factor, at least in the recent past, has been RBI forex intervention. RBI has been selling a lot of dollars and that has drained the system of liquidity. And perhaps the RBI has not compensated the system in equal measure for the liquidity which has been drained out. That is number one. I will get into this in detail as you ask, maybe when we discuss this subject more. But the second important factor is a fluctuation in government cash balances. As all of us are aware, the RBI is a banker for the government holding the sizable part of the government's cash balances. And these cash balances keep fluctuating depending upon whether the government is expending those balances or not expending those balances. The more the government spends, the more the liquidity in the system. The less the government spends, naturally, the less the liquidity in the system. And that's a very, very important factor which plays a very big role. And this particular factor gets augmented in the advanced tax season, and a lot of advanced tax is paid by the corporates to the government. A lot of money goes and settles in the Government of India account. And it also actually happens that the government spends very hugely in some seasons, creating a huge amount of liquidity buffers in the system. A third is actually a little minor factor, but then it can play a very important role, is a kind of huge cash withdrawals from the system by the consumers, by the retailers, by the corporates and all that. Typically, this happens in festival seasons in India, like Diwali and all that, when people withdraw a lot of cash. Or, while people may not admit it officially, during election times, there's a huge amount of cash in circulation. A lot of money has been withdrawn. So these factors are very important factors which contribute to these kinds of whiplashes in the liquidity conditions.
So that brings me to a very important question that most bankers have been asking. Does this show limitations to the RBI's current liquidity management framework and the tools it uses? Is there a need for the framework to be looked at again in the current context? given that probably the RBI will soon shift to a accommodative stance?
Yeah, again, that's a very important question, but I may not be able to answer this question directly since I don't have a first-hand experience of RBI being in RBA right now. I'm out of RBA for some time. But then clearly, RBI's toolkits permit it to assess the extent of a temporary liquidity variation and a permanent liquidity need in the system. In fact, RBI uses a very good term for that. One is a structural liquidity gap, other is a frictional liquidity gap, or a temporary or a permanent liquidity gap. Now, a temporary liquidity gap could arise because of, as we talked about, cash withdrawals from the system, or the government is holding a huge amount of cash balances and it is yet to spend it, or RBI is intervening in the forex market and there is some kind of a resultant deficit of liquidity in the system. These are clearly frictional liquidity. Now, I would definitely say, while RBI is quite well aware of these frictional liquidity gaps and the structural liquidity gaps, I'll explain the structural liquidity gap also in a minute or two. Anytime a frictional liquidity gap arises, RBI should be ready to inject that amount of liquidity, a compensatory liquidity. I have really not understood what has been the reluctance on the part of RBI in infusing this liquidity. Unless this liquidity is already present, perhaps RBI may be a little reserved. But if the liquidity is not present, it has been withdrawn, RBI's job is to infuse this liquidity, a compensatory liquidity. Why RBI is not doing it is a question which I have not been able to get an answer to it. Now, before that, let me just explain what the structural liquidity is. All of us understand that for GDP growth, we need certain amount of liquidity to support this kind of a GDP growth. If the corresponding liquidity is not injected, then perhaps the prices would fall because the same amount the additionality in the goods and services produced are not matched by the money supply in the system. Clearly, the prices will fall. The value of money goes up, but the prices will fall. This is not a situation that the central bank would like, but this will definitely bring down the inflation, no doubt about it at all. But at a very heavy cost. That the deflation, if it is going to be a well entrenched or a kind of a deeply entrenched deflation, it is going to create a huge amount of problem for the economic agents to operate in the system because they will not be able to do any economic activity with the kind of profits that they are anticipating. So this is a very serious situation. So I would say, while the liquidity framework would not have to be drastically altered, RBI has to be very, rigorous in following certain tools which it is already aware of. Anytime a frictional liquidity shortage is occurring, RBI should step in and infuse that liquidity. Anytime a frictional liquidity excess is occurring, RBI should suck out that liquidity. But this should go on one track. The other track is the structural liquidity, which is actually supporting the GDP. Now, for supporting the GDP, that kind of a critical mass of liquidity, which is essential, should be there in the system. Now, RBI cannot play around with this critical mass of liquidity because that will adversely affect the GDP. So, I would say maybe the awareness within RBI that structural liquidity is something which has to be injected come what may, and frictional liquidity, RBI has to play its role of sucking out or putting it in, is a simple, I think, a game that RBI will have to play.
So, do you think that there must have been some challenges for which the RBI did not do this till December? That RBI didn't infuse such structural liquidity. RBI didn't infuse enough liquidity to take care of the frictional liquidity aspects. Did that happen? Because of which the system has had problems?
Yeah, I'm just thinking whether it has been due to RBI is looking to manage inflation through this. Trying to actually inject less liquidity and contain the inflation. But in the process, what we are losing out is on GDP growth. And GDP growth is a very critical component these days because worldwide people are not growing. And if India is growing, India should be able to keep up that impulse of growth. It should be able to keep up the momentum of growth. If this momentum is going to come to a halt, it's going to create a huge amount of problems for the Indian ecosystem as well as the world ecosystem that we have to be very well aware of. So this is where I feel that If RBI, after having done the forex intervention, was reluctant to inject that kind of a liquidity, more from the angle of inflation management, which I am not able to confirm at all. As I told you some time back, I'm not a part of RBI. If RBI has been actually, it has been occupied by the feeling that inflation management is very, very important, then perhaps I think there is something wrong. I think RBI should have given way to the liquidity to be injected to meet the shortfall which has been created by RBI's own intervention. So that's where I feel the problem lies.
So there has also been a debate in the same context that the tools that RBI has been deploying for a few years now, uh, uh, as opposed to the main tool, which is an overnight fixed rate repo, and some analysts say that we've had a 20-year experience, a good experience of dealing with a fixed rate repo. Would would those sort of instruments or lack of that kind of an instrument create this kind of a problem for the banks which are not able to make a correct guesstimate or an estimate of what kind of liquidity or what is the thinking of the RBI with regard to liquidity and the liquidity stance, and therefore the markets have been badly affected because of that?
Yeah, I think your question again is pretty valid. My feeling is that there is a lot of confusion perhaps in the minds of the policymakers as far as the repo tenor is concerned. If you think that basically the structural liquidity gap could be actually met by the overnight repos and all that, it's going to go for a toss. I think the economy it doesn't get a kind of a long-term liquidity which it wants, which the banker wants to lend it on a long-term basis, 1 year, 2 year, 3 year loan. He can't be lending out of overnight repos a 1 year loan, which will create a serious asset liability mismatch in the banking system book. Maybe there are intermediate agents who will collect this liquidity and then lend it long term and all, hoping to roll over the repo and all. But mind you, they are also going to run a risk if they are going to bank on this overnight repo. So my simple solution to this is, while overnight repo will not address a problem of structural liquidity at all, it's only an instrument to address the frictional liquidity. If you are thinking of a fixed rate repo, even the fixed rate repo has to be of a longish term. I won't mind a 3 month, 6 month fixed rate repo in times of structural liquidity gaps to fill up the structural liquidity gaps. Now, if you are trying to address it through overnight, it's going to definitely give rise to these problems of mismatches and the credit not taking off and the transmission not being seen in the system.
Uh, but the counter argument to this has been that as opposed to fixed, the RBI has been wanting to have a good reference rate, a term structure to evolve. So to that extent, it has moved from fixed rate repos to variable rate repos. And then a 14-day repo has emerged as the main tool in the last few years. So how would you, in the context of the mismatches that have happened, primarily because of RBI's intervention in the currency market, do you think these instruments have stood the test of time?
See, as far as the development of term structure is concerned, I don't think we have really succeeded. This is my very blunt answer to the question. Now, when we talk about a term structure, if you are thinking that in the yield curve, at every point we need a reasonable amount of secondary market transaction to make it really a tradable kind of an yield curve, I think we clearly don't have that. Maybe even the developed economies may not have that. But what we should aim for is something which is a little more practical. I think we should aim for a yield curve where at critical points in the yield curve, for example, you start with the money market, 3 months, 6 months, 12 months, 2 years, 3 years, maybe about 5 years, 7 years, 10 years, 15 years. If you have a yield curve at these points, I think that's good enough for us. We can't be expecting a yield curve every point. So this kind of a term structure, what we are actually thinking of developing, I think that's a kind of a utopian dream. So I would not say that that is something which we should really go after at all. So from that context, if we thought that the fixed rate, if we thought that this variable rate repo mechanism that we are giving for different periods will develop a kind of a term structure, I don't think we have succeeded.
So there is one more aspect. Probably you alluded to that a little while earlier. We have seen that the RBI's balance sheet growth was pretty slow in the first half of the year. Probably it's only picked up only from December onwards. Do you think that has also caused a very serious problem with regard to structural liquidity? and
Quite a
has put.
No, I completely agree. This is quite a possibility because if the RBI balance sheet has not grown commensurate with what is required for the GDP growth. I mean, GDP growth, all of us understand the fundamentals. Number one, there is a money multiplier effect and there is a velocity of money effect. The money multiplier is whatever is the X money that RBI pumps into the system, the hardcore money pumps into the system, that gets multiplied into 5.5x in the form of bank deposits and all that. This 5.5x again multiplied by the velocity of money, which is close to about 1.2, 1.3, 1.4 in the system, actually results in the money supply, the GDP actually. So GDP to money supply, that ratio velocity of money should be reasonably be stable. In India, it has been reasonably been stable. Some amount of fluctuations take place. But if you try bringing about a huge amount of change in this velocity of money, it definitely affects the overall liquidity in the system. So for that not to happen, which means basically GDP should grow and the liquidity should grow commensurately, RBI's balance sheet should also grow. So again, I come back to the same factors. If RBI has done forex intervention, RBI has lost actually assets from the system, assets from its balance sheet. It has not replenished the assets. How does RBI replenish the assets which it has lost through the foreign exchange? Obviously, to open market operations through bonds mechanism. Perhaps it has not done that. That is something which perhaps could explain that. The other explanation where I will give credit to RBI is that if RBI's GDP projections are not coming true, RBI projected a GDP growth of say about 6.5%, but the GDP growth is lagging behind at 5.4, 5.5, then RBI is right in not injecting the liquidity which was originally not projected. But then at the same time, the fact remains that the GDP is growing at 5.4, 5.5. That also needs a structural liquidity injection. So if RBI's balance sheet is not going to get augmented by that size, certainly it is going to impede. It is going to come in the way of the GDP growth.
Sir, if you were to change some aspects of liquidity management framework as it exists now, what would that be? What would be your recommendation as a practitioner for so many years?
See, I think that's what I was hinting at all through. One is, I don't think I'm going to do any great change, except that I have every mechanism to assess the frictional liquidity in the system. I have every mechanism to assess the structural liquidity gap in the system. I may go wrong by about plus or minus 5%. That's fine. That's an error. That's an acceptable error. But anytime there is a frictional liquidity gap, I should be willing to come and give that kind of a liquidity, take out the liquidity through the appropriate instruments. It could be overnight, it could be variable rate repos and all that. But whenever there is a structural liquidity gap, I should not be reluctant to pump in that amount of liquidity either through open market operations or through long-term fixed rate repos or even through FX swaps. Now, FX swaps now recently they have done, which perhaps is a 3-year maturity, if I remember correctly, which I would say is really good because this is adding a permanent or a structural liquidity. It's adding to the filling in the structural liquidity gap. This is what RBI should be doing all the time. So I don't have any other advice. I would only say that be alert to the frictional liquidity gaps, be alert to the structural liquidity gaps. Don't allow the structural liquidity gaps to develop at all because this is going to affect the economic growth. Allow the every time fund the structural liquidity gaps through appropriate instruments like OMOs or the FX swaps and the frictional liquidity gaps through the other instruments that we have at our disposal.
So, would you sum it up that RBI may have made some tactical calls with regard to not replenishing the liquidity, not expanding the balance sheet size, from the perspective of inflation management, or some sort of a rethink on what kind of growth projections will actually materialize? Do you think this could have been the thinking if you're dealing with conjectures at this point of time?
No, you're saying that RBI has made a tactical call now. That's what you're saying?
Earlier, sir. Earlier before December, when RBI kept liquidity tight and did not expand the balance sheet.
Possibly. I definitely feel that at the time RBI's tactical call was to manage inflation. That's my surmise. And that I think basically in the midst of, growth which was sputtering clearly created problems. And the government perhaps thought that perhaps what the RBI is doing is not the right thing.
So you mentioned about foreign forex swaps as being a very good tool which has been deployed by the Reserve Bank of India. Would you say would you say these have the same heft as open market operation and even a cash reserve ratio cut from the perspective of what we initially discussed about having enough liquidity to support growth?
That's again a very good question. Actually, the thing is, see, these are different toolkits that RBA has. You can have open market operations, you can have FX swaps, you can have liquidity adjustment facility, all that. FX swaps are basically used, number one, again, you don't try using an FX swap without disturbing the forward premium. So if you think that the disturbance in the forward premium which is going to take place is in alignment with your objective, let us assume the forward premium is rolling very high. So you want to bring the forward premium down. Fine. At that time, you do a buy-sell swap, so it definitely brings it down, which is going to be in alignment with your forward premium objective plus the monetary policy objective. Ideally, I would say that what the RBA is doing currently, and even during, I think, last regime, was that FX swaps were deployed for a long-term purpose. So clearly, that as an instrument of injecting liquidity really helped, injecting the structural liquidity, which was very, very good. It was actually maybe bringing about some kind of a disturbance in the forward premium, but that was to the comfort of RBA. So again, not a problem at all. Had you done an equivalent amount of open market operation, the bond market yields would have actually moved much more than what the monetary policy had really aimed at. So without disturbing the bond yields in a big way, of course, the forex swaps will also, have some kind of an impact on the bond yield, but the open market operations have a much larger impact on the bond yield. So perhaps RBI is opting for the forex swap, that too a long-term forex swap, basically to augment their structural liquidity. I think was a very wise move, and that way this is a very potent instrument, and this instrument should be used as and when the situation is going to be conducive from RBI objectives and RBI perspectives.
So one central objective of doing a swap, as most experts say, is primarily to augment foreign exchange reserves. To that extent, do you think this is a durable instrument from a reserve accretion perspective and even from a liquidity perspective? The fact that they're doing a longer term ones is appreciated, but just to analyze this particular instrument, is this something which is very durable, even from the reserve side and even from the liquidity side?
Absolutely, you're right. Actually, from a short-term perspective, augmenting the reserves, I won't favor this instrument at all. I would just not touch this instrument at all. I don't think it's going to be RBI's job to actually boost up the reserves, that too temporarily. See, if you can do a long-term kind of a swap where the system is prepared to lend you dollars for say about 3 years, 4 years, that's good. That's what actually perhaps in 2016 it was done. A FX swap at a concessional rate, it was done. 3 years, it augmented the reserves. It actually created a positive sentiment in the market that RBI forex reserves are going up. But then if you are going to augment the forex reserves for 1 day, 2 day, 1 week, 2 weeks, it doesn't help at all. So I would say that this is not an instrument meant for the short term at all. If you are looking at augmenting the forex reserve, it should be a long-term augmentation. If you are looking to augment the liquidity in the system, again, it should be more of long-term. Short-term swaps are seldom going to be potent instruments to manage liquidity or to manage forex reserves.
So one aspect has been that, which has been generally missed. Are there any risk factors to using forex swaps, especially given that they impact the forward premium? Is this an instrument which is very safe in the current context of external uncertainty? Do you think this is a safe instrument?
See, actually, what happens is number one, there is a general misconception in the market when RBI does a lot of forex swap, the spot rate is going to get affected. The spot rate doesn't get affected by the forex swap at all because swap is a kind of a borrowed dollar. Whereas the rate which gets affected is actually a position dollar where you sell and buy, outright sell and buy. So basically, it's not going to affect the spot rate at all. But at the same time, one has to really look at a situation where RBI does a huge amount of forex swap, that too the kind of forex swap that you mentioned, short-term forex swaps. When it does it, all the dollars in the systems are going to be absorbed by RBI. It creates a kind of a dollar shortage in the system, with the result that what will happen is when RBI does more and more of buy-sell swap, the premium will keep going down. Once it touches a point zero, it actually gets into negative. Now, negatives have also, we have seen in the forex market way back when there was a huge amount of dollar shortage, forward premium fell into negative. Now, these are situations where perhaps we are actually defying the market fundamentals and actually employing an instrument which could create some kind of a long-term disturbances in the system. So I would say from that perspective, one has to deploy this instrument very carefully. And the last thing is, of course, evaluation. Now, in RBI, of course, the valuation does not matter because RBI, whether it makes profits or losses, it doesn't create that kind of a ripple effect in the system. But in the commercial entities looking at an artificially, lowered premium, they do something in the market, it could affect their balance sheets over a period of time. So one has to be cognizant of this. But I would say, net, if you look at the overall risk emerging from this instrument, it's not something which is very substantial, I would say.
Yes, sir. So one more aspect which has come out in the recent past is that RBI was accumulating reserves. In fact, it was a stated policy sometime in April last year that RBI is or has been accumulating foreign exchange reserves. There was also some comment in one of the speeches that India now has probably the fourth or the fifth largest foreign exchange reserves. Is there has been a corresponding concern also that India's foreign exchange reserves are a borrowed money in the sense that these are not trade related flows, these are all capital inflows, probably even hot money. So to that extent, we posting about very high reserves may not be a great thing. And when some turmoil happens, as it's been happening now, the money will go out. So to that extent, I would want to know from you, what do you think about the quality of the reserves at this point of time? Or the signaling effect of the quantity of reserves that we have is good enough to lend stability to all economic constituents?
You're right, Kalyan. Again, actually, the point here is, yes, you're right. Entire RBS reserves are borrowed reserves, because if you compare it with even with a simple measure of external debt, I think we are there exactly where the external debt is, or even a little less than the external debt. So clearly, every single dollar in the reserves are borrowed reserve. Whereas compare that with China, which has a few $trillion reserve, everything is a owned reserve, which is around arisen out of current account surplus. So clearly, when you look at the quality of China's reserves vis-a-vis our reserves are completely owned reserves. Theirs is owned reserves, actually. But then, are we trying to create a mirage then? That's a very important question that we are trying to discuss. Are we trying to create a mirage in the minds of the people saying that, look, our forex reserves are fifth largest in the world and all that? But we have to bear in mind the fact that not many countries across the world are current account surplus countries. So it's going to be difficult for them to actually accumulate reserves out of current account surplus. So these countries, the very fact that they have an ability to borrow, they are able to augment the reserves to the capital flows which are coming in. And a good part of the capital flows will stay in the country. They are not going to go off in a jiffy. Is something which adds to the economic heft of the country's image, actually. So while I would say owned reserves are any day better than the old reserves, but even the fact that you are able to borrow these reserves at a rate which is going to be comfortable to you is definitely a tribute to your economic resilience.
So one more point you spoke about was the volatility in the government's cash balances and the resultant impact on frictional liquidity. Although the Reserve Bank of India's position could be that it doesn't control the government's spending patterns, but from a system as a whole, the system suffers with uncertainty with regard to liquidity. So, do you think there is a solution that the government and the RBI could actually look at to address this particular issue of volatility in government becoming a factor and upsetting the RBI's equations with regard to liquidity management?
Yeah, this is one question that RBI and government have been actually discussing for quite some time, but unfortunately, they have not been able to arrive at a good, amicable solution. The first solution in my mind is Government, when it is spending so much of money, they should have an estimate of what they are going to spend at least in the next about 10-15 days, even not for the whole year. They may have a whole year one estimate, but how is this entire expenditure going to be spread out over a period of time is something which they will definitely have, and which should be, if they don't have a very accurate kind of an estimate, they should be able to spruce it up over a period of time using all the seasonality models and all that, which is a doable thing. And the government should do it. Government should share this with RBI for better liquidity management. No doubt about it at all. So it is definitely within the coordinating capacity of RBI and government to work out a model which can actually tell you the next 2 days, next 3 days, next 1 week, how is the government expenditure going to evolve. Now, again, it need not be very accurate. Even if it is about plus or minus 5%, it's good enough, no problem at all. Good part of the liquidity problems could be solved. Second, when this was not actually, I mean, the government perhaps felt that this kind of an estimate is something which is a utopian exercise. What RBI came up was a very, very practical solution. Why don't you auction your balances? When whatever balances the government holds with RBI, it could auction in the system, and then government can actually take a return out of it. This is something which is again workable. If government could auction out these balances depending upon the kind of a spare capacity of these balances, how long these balances are going to last. If it is going to last for about 15 days, for 15 days it can inject these balances into the system. This is something which is doable. Again, the government and RBI will have to sit together and evolve the systems which could really address the liquidity management issue in a very big way.
So one more issue that has been a problem has been currency leakage. I think especially after pandemic, I think that problem has only compounded. So what can be done to address this particular issue, which is a big challenge from a liquidity management perspective?
See, I don't know. I really don't have a clear idea about the gravity of the problem right now. I completely agree with you. At the time of COVID, we had a huge amount of currency leakage because people wanted to hold a lot of cash, knowing that actually things will not be otherwise, transactions would not be possible with the whole economy getting closed down. But I don't know whether the problem is of a same magnitude today, because a lot of payment system apps have emerged where people using cash has come down to a significant extent. So to that extent, I would say that I mean, the cash leakage component might have come down. This is my surmise. This is my conjecture. This has to be, I mean, I have to read it through the figures whether this is a come down. But nevertheless, your point is valid. I think if there is a cash leakage problem, I think we need to really address it. And RBI and government will be best placed to address it in coordination, in a coordinated way. Now, whenever cash leakage is going to take place, they should be able to anticipate and they should be able to see how long the cash is going to remain in the system, when is it going to come back. There are estimation models available. As I told you some time back, maybe at the festival times, the cash goes out, but it does come back after about 15 days, after about 20 days. These estimation models would definitely be of great help, but they should be very carefully calibrated estimation models, and they should be used with, I mean, the past experience being our future guide.
So the regime change has brought in a lot of urgency to liquidity management. RBI has announced a huge forex swap again, and it has announced a significant open market purchase operation. It has been welcomed by the market. Do you think these will have to be repeated for the next couple of more months to ensure that liquidity actually goes into a somewhat surplus zone? Because RBI wants to cut interest rates, wants to support growth. So to that extent, do you think there is a need for actually system being in a surplus zone becomes extremely important?
Again, I completely agree, because basically the monetary policy stance will have to run in two tracks. One is the liquidity, other is the interest rate. So in the interest rate, we are thinking of a kind of an accommodative stance that RBI wants to adopt. It cannot be run with a tight liquidity stance at all. It has to be run with a bit of a surplus. I'm not saying that flood the system with liquidity. At least have a bit of an excess liquidity in the system. That's very much essential. So I would say from that perspective, what RBI started doing of late is absolutely what the system needs. doing this kind of open market operation is going to replenish whatever was a shortfall which was created about 3-4 months back. So that is going to replenish that gap, and then plus leaving a bit of excess liquidity in the system is going to actually goad the banks towards a little bit of more, credit giving. Of course, credit giving is a function of the government investment, the private sector investment, and all that. If that is going to happen simultaneously, the government investment, the capital expenditure, and the private sector capital expenditure, then perhaps the credit can also move out of the bank. Credit can also be dispensed by the bank, and that will spur the economic growth. So I would say the need of the hour is to handle the liquidity in a way that we have a bit of a surplus liquidity in the system, not have any structural liquidity gaps at all, have an eye on the GDP growth so that it doesn't slacken at all, and definitely you are going to have an eye on the inflation. But thankfully, the inflation is tending to behave in a very benign way. So, in fact, this is to the advantage of RBI, that RBI can practice all the surplus liquidity models with a greater amount of leeway, greater amount of legroom than when the inflation is actually going to rear its ugly head.
So this is the best time you would say that the RBI can also consider a change in stance?
I would definitely say that yes, it definitely looks so. I mean, the inflation figures that are put out, they are looking absolutely benign. Maybe another month's data would reveal how we are really positioned. So, but with all that, we should never allow the GDP growth to go down at all. So we should be able to really perk up the GDP in a big way. That's the government's objective. That's the RBI's objective. So I would definitely strongly favor a stance which is going to be a little bit accommodative with supporting liquidity.
Thank you, Mr. Mahalingam. It was very nice talking to you.
Thanks a lot, Kalyan. Thank you.